Assalamu alaikum. Inshallah, you're well. So, most of you will know that I work in internal audit, which is one of the many routes open to you once you qualify as a chartered accountant. And you'll notice I said chartered accountant there because most internal auditors are actually qualified with either the ACA, ACCA, or ICAS qualifications. It's very rare that you find an internal auditor with a CIMA qualification. However, it is possible if you've qualified with the CIMA qualification in industry as an example, you can potentially second or rotate into internal audit. So inshallah, over the next couple of videos, I'm going to talk about my experiences in internal audit, what led me to decide to pursue internal audit after I'd qualified, and also the pros and cons. So inshallah, you find this content useful. What I will say is, some of the content may be a bit dry, but don't let that put you off. There's a reason why I've stayed in internal audit over the past 5 years, and in the short to medium term want to remain in internal audit. So watch these videos with an open mind. Firstly, we have to understand what is internal audit. So internal audit is a department of a business that provides independent assurance over governance, risk management, and controls. Now let's break that down. So the key term is independent. And when we say independent, we mean free from management influence. So internal audit departments will report into the audit committee, and that's how they remain independent. So the audit committee is a board level committee which is made up of both executive directors, which are from the business's management. So that will include people like the CFO, CEO, those in very senior positions, and non-executive directors as well. So these are independent directors who aren't part of an organization's management team. So the benefit of having non-executive directors is because they have a lot of industry experience but don't actually work for the business, they may be able to give a fresh insight. So as internal audit report into this committee, this reduces the risk of management influence and compromising their independence. So the next bit is assurance, which basically means comfort over a subject matter. Now, typically when you say assurance, you may automatically think audit and that's it. However, there are loads of examples of assurance that happen in our day-to-day life. So for example, you may fall ill and you may go to the doctor to get yourself checked out, and the doctor may give you assurance that everything's okay. Another example that I'm familiar with is when I was doing my A-levels, I asked for one of my exams to be remarked. Now, the examining body was giving me assurance that the result that I got first time was correct because the exam was reviewed by an independent examiner. So just because I say assurance, don't think, oh, it's just related to audit and that's it. There's loads of examples in our day-to-day lives. So what do we mean by governance? Governance is a reference to the organization's management structure. And we're not talking managers here, we're talking the top dogs. So senior directors, the CEO, the CFO, senior vice presidents, most of those guys will sit on board level committees, which will include the audit committee. There may also be a remuneration committee, which is responsible for deciding the pay of senior management, and other committees which will assess the organization's strategy and how it's performing against its key objectives. As I mentioned before, these committees will be made up of both executive directors and non-executive directors. And examples of good governance will be, regular meetings. So the committee's meeting maybe once a month or once a quarter, with those minutes documented, regular updates on performance and queries raised from previous meetings, and overall improved company performance, which will result in added value to the shareholders. So the next one is risk management. This is all about how an organization understands and manages its risks. So every single organization doesn't have to be a member of the FTSE. It could be, a small company with maybe one employee, will have some form of risk, and effective risk management will involve documenting the risk, regularly assessing it, how it's changing, and reporting on progress. So a common risk that's facing, quite a lot of organizations at the moment is COVID-19. How do organizations cope with the loss in revenue, the regular lockdowns that we're facing, reduced customer demand? How do we all adapt to that? And the big companies especially will have this noted down as a risk on either their risk management system or on a separate risk register, and will be providing regular feedback to management on how they're keeping up to date with, government changes in legislation, taking advantage of all the funding that's available at the moment to manage this risk. So the final one is controls. And an oversimplified definition of controls is any action which manages risk. Now, when I speak to a lot of people, they're like, oh, I have no understanding of controls, or I don't get it. But actually, we have loads of examples of controls which operate in our day-to-day lives. So a common example is setting an alarm clock to wake up. So the action in this example is you setting up the alarm, and the risk that you're managing is you don't want to wake up late. So actually have a think about, what you do on a day-to-day basis to manage risk. And the chances are you can come up with loads of examples of controls. However, from a company perspective, a simple example of a control is when you check a payment back to the original invoice to make sure that it's correct. And the action is you checking the payment, and the risk that you're managing is the fact that you may make an incorrect payment. So now that we know what an internal audit department does, let's talk about how a business can manage its risk. Now, there is a common model that's referred to, and if you study accountancy at university, you may have already come across this, but this is the 3 lines of defense model. And the first line is day-to-day management and the control environment. So this will involve departments who are responsible for performing the controls. So as I've mentioned in the previous slide about the example of a payment being checked, that's likely to be done by the Treasury Department, who manage access to the banking platforms. Another example may be that before posting a journal in the accounts department, it gets reviewed by a senior member of management. So the first one is really summarizing the day-to-day actions taken by employees. So the second line of defense are the departments which are responsible for managing the risk. And they'll be primarily responsible for drafting the policies and procedures in place. They may also do some monitoring to make sure that those involved in the first line of defense are performing the controls effectively. So to summarize, the second line of defense are responsible for creating the policies and procedures and monitoring compliance, whereas the first line of defense are responsible for the day-to-day operation of those controls. And the third line of defense is where you get internal audit. So this is where, as I've mentioned before, the department provides independent assurance to the audit committee that this process or subject matter is operating effectively. And it's not just as simple as some departments will only be involved in the first line of defense or the second line of defense. As an example, although internal audit are in the third line of defense, they may assist with the second line of defense because they may review policies and procedures. If you think about it, internal audit will have a lot of experience auditing different subject matters, so they can advise other departments which manage risk on best practice. What improvements they've seen whilst auditing other departments that can be implemented across the business. So it's not just a simple case of, oh, if you're in the first line of defense, that's it. You can't be in the second line of defense. The key bit to note is that internal audit can't be responsible for operating the controls, because that leads to a self-review threat. Essentially, that internal audit will be reviewing their own work. If you remember in the first slide, I said the key bit about internal audit is that they're independent and they have to remain so at all times. So let's go through the typical audit process. So the first stage of an audit process is scoping. So that's essentially deciding what you're going to audit. Now there's a few processes that can help you decide. So firstly, there may be management feedback. So this is where the CFO may come up to you and say, well, we've realized there's an issue in this particular department. Can you please go and audit that particular area? Remember, management are responsible for operating the first line of defense. So they'll have a good understanding of their day-to-day operations. So will most likely be the first stakeholders to identify a risk. Then you also have the audit committee. So they may provide some direction, say, you know what, this is something we've seen as a problem in the industry. Can you go and audit this area? You also have external auditors. So they may identify something as part of the external audit which requires further evaluation. And then there are also what we call reactive audits. So this is where, there may be an instance of fraud or error that's arisen, and you may have to drop other projects so you can focus on this because there may be a huge risk associated with this fraud or error. As part of scoping, you would normally tell the stakeholders, i.e. the head of internal audit, the audit committee, that you're planning to perform these audits. This will also involve a discussion with the head of department so that they're aware. The only time we would really cut out people is if, for example, it's a surprise audit. Again, in the example of fraud, we may not want to alert a particular department that we're doing an audit. So we may just go in and audit without giving any prior notice. So once you've decided what you're going to audit and you've made the relevant stakeholders aware. The next stage is planning the audit. You may not have the foggiest about what you're auditing. So as part of this process, you will understand the subject matter, and that will involve interviews with relevant people. So potentially people from the department, other people who may have some knowledge of this particular process that you're reviewing. And as part of planning, you'll be understanding, okay, what are the key risks involved? What do I need to focus on? The thing you've got to remember in audits is you won't be able to review everything. It's just not possible. So you'll have to focus on what the key risks are and what the key areas of concern are going to be from a management or an audit committee's perspective. As part of planning, you'll probably determine how long the audit's going to take and what information you'll need to review as part of the audit. So it's at this stage where you may submit an information request list, which will include details of all the information you require for the audit. So once you've done the planning stage, you then go on to fieldwork, which is the core testing of this. So as an example, if you're performing a HR audit and you're reviewing employee contracts, you'll request these as part of the planning stage, and you'll review the contracts as part of the fieldwork stage. So it's just a reference to the audit testing that we perform. And then the final bit is reporting. So how do you report the results of your audit? And that's typically done in an audit report, which in my experience involves a lot of presentations. So you'll normally have to present to the head of department to let them know what you found. And depending on the company, this may also involve presenting to other senior directors. And it will typically end with the head of internal audit presenting this report to the audit committee. So in the audit report, you'll identify what the key findings were. As an example, say if you find a 10p error, is that something the audit committee is going to be interested in? Definitely not. So you would only report on key matters, and in the report you would also have a documented remediation plan, which basically refers to how the business is going to fix these errors or implement improvements to make sure these findings do not happen again. And in internal audit, once the report has been issued to everyone, you may also be responsible for obtaining updates to make sure management do actually implement their remediation plans and do address the findings that you raised. So that was a brief summary of an internal audit department and what they do. I just want to recap some of the key terms that are used and common acronyms that are used in the industry. So firstly, we have IA, which is a reference to internal audit. And as you should know, this is just the department that provides independent assurance. Secondly, we have AC, which can be a reference to the audit committee. They're responsible for the management and oversight of assurance projects. And remember, when I say assurance, it doesn't just mean audits. So as well as audits, the audit committee are actually responsible for the oversight of the financial reporting process as well, which will include preparation of the year-end accounts. And these committees can be made up of both executive directors, which are senior members of management from the business, and also NEDs, which is a reference to the non-executive directors. So these are board level members who aren't a member of management. And the biggest benefit they bring is because they're independent and have a lot of experience in that particular industry, they can bring a fresh insight. And then what we have is RMS, which can be a reference to a risk management system. This is a system which records risk and manages progress against these risks. And it could be, simply documenting these in an Excel sheet, or it can be documented in a risk management software. And the final one, which I haven't actually referred to, is RCM, which is a risk and controls matrix. And this is very common. So this is a matrix which, again, could be in Excel or in a particular software, which details controls and the risks that they address. So a typical RCM will have the audit risk, the objective of the control, and the control activity as well. I warned you, the content may be a bit dry, but seriously speaking, I do really enjoy working in internal audit, and inshallah over the next couple of videos you'll understand more about my day-to-day role, what I enjoy particularly about my role, and some of the projects I've worked on as well. So before I go, I just want to thank everyone for their continued support. Inshallah, please do share the channel with others and encourage them to subscribe. And if you haven't followed me on Instagram yet, I'd say definitely check out my Instagram profile. Inshallah, what I'll be doing from next week onwards is trying to post regularly on the numerical tests that you may face when you apply for a school leaver or a grad program within any finance industry. A lot of people do get in touch asking for tips and assistance in how to pass these tests. And my biggest tip is, practice makes perfect. So inshallah, it's my way of saying thank you and helping people to practice with the numerical tests to inshallah give them the best possible chance of securing either that grad or school leaver opportunity. And as always, guys, if you have any questions or any feedback, any comments, please feel free to leave them below or message me on Instagram.